Every single thing I create is meant to produce the most meaningful contribution that I can deliver. I want to give people that glad-hearted certainty that comes when life is wisely navigated so that people flourish in every possible way. Hey everyone, and welcome back. It's Jonathan here. And in today's video, I'm going to address one of the main questions that I'm asked all of the time, and that is, John, what's going to happen with the real estate market? It's a really important question. It's a complex question, and it's one where we need to take all of the different pieces of the puzzle, isolate them, put them together, and then answer some questions about implications. If you're new here and you're wanting real-time updates on the real estate market, hit the sub button so you're notified when I post a new video. I typically post a video about once a week now so that you can have the data that you need in order to multiply and protect your wealth in and through real estate. So let's get to the topic of the day. What's going to happen to the market? Is the market going to tank? Is it not going to tank? There's a ton of noise right now about the struggling real estate market, about the stock market on the rise, the GDP on the decline. We've got unemployment rate at historic numbers. This comes as a result of COVID cases that are rising, stock markets selling off. All of these things are taking place, and at the same time, we're faced with another threat of lockdowns. As of this recording, November 16th, 2020, I live in the state of Maryland. There are rumors about another lockdown happening, maybe even not just locally, but also nationally. While we still don't have anything substantial on whether or not there will be another stimulus issued. So how do we actually put all of these pieces of the puzzle together and understand when and if there is a housing crisis coming, and if it's coming, how bad it's going to be, and how you can be in a position of anticipating and not reacting, because if you can anticipate, you're going to have that much more advantage to making decisions and really multiplying and protecting your wealth in and through real estate. Well, in this video, I'm going to go through the key variables, and I'm going to give you some projections in terms of exactly what I think the market is likely going to do. First, let's talk about this one important thing. And that is something called the Housing Affordability Index. We're going to keep this really, really simple and just get to the bottom line here. Typically in real estate, when prices go up, that translates to people actually having to pay more money on a monthly basis to buy that piece of real estate. So unlike stocks, real estate can't really go to the moon. It has to be affordable, which means prices are literally bound by people's ability to pay for that house. Unfortunately, housing affordability has started to decline, and let me tell you why. It's called the 10x rule in real estate, and that rule states something very simple. It states the following: for every 1% that interest rates go down, prices go up 10%. What's also known as the 10x rule. And that's exactly what's happened. The reason why this works is when interest rates go down 1%, prices go up 10% because people can typically afford to pay 10% more for a property. And that's exactly what happened. Interest rates fell about 1% or more now, and prices went up about 10% year over year, or even more than 10% year over year. You were up 10%, in some cases even 14%, some cases even 21%, because rates have fallen even more than 1%. At the recording of this video right now, the average 30-year fix is right around 2.73%. Average 15 is 2.33%. Rates are insanely low. So you see this immediate kind of push and pull with prices and interest rates. And this makes sense again because real estate is tied to people's ability to afford the property. This led to a pretty nice, really freaking boom in real estate if you were buying or if you already owned real estate prior to about August and July of this year. If you went shopping for real estate in May and June, you probably got a much better deal than you could have gotten really today or just a few months prior. And that's just the nature of the market adjusting to rates having fallen. But now that prices are higher, any benefit that lower rates had is somewhat almost gone for new buyers. New buyers are thinking, yeah, I get a low interest rate, 2.73%, but oh my goodness, look at these prices. They're way higher, 10% higher plus, and that's a problem. And so that's where we see affordability go down. And we're starting to see, according to the National Association of Realtors, housing affordability decrease, in some cases, actually substantially. It's at the lowest level that it's been in the last 3 years. And this creates some real challenges because when comparing median income to median home prices and the median income falls below median price, well, you can just do the math. We've got a problem, and this is when home affordability goes down. The growth of prices gets limited. To see this, let's go ahead and look at Redfin's data center. You're going to be able to see this as I pull it up here, and we'll see exactly what I'm talking about. So this here is Redfin's data center, and what we want to look at here is we've got a chart of median home sale prices in the DC metro area, and this is sort of averaged out over a 4-week duration. And what we really want to watch is the 2020 data, which is going to be the right here. And so what we could see is we've really seen prices increase, right? Here's June. It's kind of right here for us. And what you can see is this very clear increase in prices. It really makes it clear that the best time to buy a property was between May and June. If you bought after that, again, you paid more than those prices with a cheaper rate. And so what's happened since then, because rates have stabilized low, is we've got a lot of buyers coming into the market. You get real estate prices essentially going parabolic here for a moment, and then you get this incredible growth. But then you start having exactly what we would expect to happen. A flattening is occurring. See, this flattening that we're having here is caused in large part by the issue of housing affordability, what we just talked about. There's a limit, right? You get this big, massive boost because, oh my goodness, look how cheap rates are, and oh my goodness, everything became more affordable. And then, oh, well, okay, now we've got these new 2% or 2.5% loans on a 30-year fixed rate, but holy cow, we're hitting the ceiling and we can't get above this ceiling with purchase price anymore. And that's one of the downsides of real estate. You can't expect it to go to the moon like stocks possibly can. Now, don't misunderstand me. This doesn't make real estate a terrible investment. Real estate's a great, phenomenal investment. It just makes it a different investment. And it's important to know this. So really what you get is you get price stabilization. But price stabilization is just one factor here. Price stabilization does not necessarily mean prices are going to fall. It just means, okay, we're flattening out. We're not necessarily going to see a dramatic increase or a dramatic decrease here, aka crash. So instead, what we're going to focus on is the second thing, and that is rents. And there are two parts to rents. To give us an idea as to what's happening in the real estate market, in the housing market, there's current rent and there's back rent. Current rent and back rent. Let's go ahead and start looking at current rent. Current rent, this is good news, means what percentage of tenants actually paid their rent. And when we go and look at that, we can see if we're seeing an inflection point where we're starting to see declines in the amount of tenants paying, if any. And what we can do is we can go to the National Multifamily Housing Council and pull up exactly what the data says. And what we want to look at here is the data for 2020. And the good news here is when we look at October of 2020, we can see that 94.8% of tenants paid their rent. Now, that's not as good as November of the prior year, but it's one of the best, if not the best reading that we've had since this pandemic began. And so this is really good news. This brings up back rent. So back rent estimates are complicated and they unfortunately vary widely. For example, the Philadelphia Federal Reserve Bank says there were around $7 billion in back rent. And then you have other studies put together by universities that say, no, actually we're closer to $21 billion in back rent. I wish I could have better news for you, but it doesn't seem as though anybody knows exactly how far behind we are in back rent. But the reality is that all things point to the conclusion that we are behind in back rent as a country. This becomes an issue because back rent can lead to a sudden wave of tenants being evicted. When evictions become possible in January of 2021, many experts are saying that they estimate that 10 to 15 million households could get evicted come January, which would affect around 40 million people. Now, follow me here. If that happens, I don't believe it's likely that all 40 million will be evicted. Many will be able to get help from family and friends, etc. So I think let's just say we can bank on a third of all evictions filed actually go through the process. So let's assume you have 10 million homes, just to roll with the math here. You get 10 million houses and a third of those 10 million get an eviction filed against them. So 3.3 million get evicted. They get eviction filed against them. They're not all going to finish the eviction process. Some of them are going to come current. They'll figure out a way. They'll borrow money. They'll figure it out so that they don't get evicted. Then of that 3.3 million, let's say a third the landlords decide that it's best. I'm done with real estate. I'm done with tenants. I'm done with toilets. I'm done with all these things. And I'm going to sell this property. Maybe 1.1 million, as high as 1.5 million decide to do this. So let's just go 1.5 million properties, worst case scenario, that come up on the market in the event that we have 33% of evictions that actually go the distance. Now, here's where we start putting the pieces of the puzzle together. Usually, we only sell as a country in the United States around 7 million properties per year. Well, if we take 7 million and we bump that up by another 1.5 million, that's almost like nearly 20% increase in the amount of properties that would be selling in a year, except there's an additional problem. Here it is. A lot of these evictions would happen in the first half of the year. So we're really throwing a 20% increase in the first half of the year next year. And this is where we get talks of an oversaturated housing market potentially coming up at the beginning of 2021. My estimation, and I could be wrong, but my estimation would be anywhere between the second week of January and likely the last week in March. That's where we're going to see, if we do see this, some saturation from evictions and from properties coming on the market. And that can be a little concerning because that is a lot of inventory, and that will absolutely have an effect of causing prices to decline, and the home buying appetite, which is huge right now, likely will decline as well at some point because a lot of new homes will be coming on the market, a lot of buyers willing to buy and see, and this is where eviction crisis could cause real problems for 2021. In my opinion, though, 2021 will look very volatile, and the easiest way to see this is just by taking out a whiteboard, and we can go into 2021 to see what we could be looking at in terms of price adjustments. And so here's what I think that we likely may see in really just the first few months of 2021. I think what we're probably going to see is like a 40% increase in inventory if this eviction crisis happens and there is no stimulus, right? So you're gonna have right now, this is where we are. And then what we likely are going to see if this occurs, if you can see this, is you're gonna suddenly see a massive increase of inventory and you're gonna likely see prices that drop. We're probably gonna see prices drop about 15 to 20%. And that's worst case scenario. I believe we could see home prices fall in that realm, 15 to 20 in the first quarter of next year. And now that we're going to hit this threshold, people are going to see all of these deals and prices are going to fall as a result of this. I don't believe we're going to see a foreclosure crisis where you need prices to fall like 30% to start triggering a foreclosure crisis, especially since a lot of people have so much equity in their home right now because home prices ran up so high. And people because of that can refinance. And so what I think we're likely to see happen in our market is that if this second stimulus doesn't occur, and sorry, this is a really small drawing, but you're just gonna have to deal with it. We're gonna see in the first quarter here, prices drop. And then what I think is likely to happen is a flood of inventory hits, prices drop, we have a massive inventory, and then what I believe will occur, because interest rates, we don't have any reason to believe that interest rates are going to shoot back up. I believe that inflation is going to really kind of stay where it is we're going to see a short-term impact, and then I think we're probably going to see a V here shape recovery, and then the market likely flattens out to where we are or will be in 2021. We could see this V in real estate as basically evicted properties come on the market, landlords dump them, those properties, and they come in a concentrated period of time where we see prices fall 10 to 20% for a short period of time. So if you're an investor, get your cash ready, so to speak. I think we will see prices lift back up, again, if we don't get a second stimulus within 5 to 10% or so. And we could see this lingering negative 5% that we see, 5 to 10% of where they are. And then I would expect us to continue on this more like, I think, either leveling trajectory or even possibly slightly go up. But home affordability is going to affect that. So I think we'll see lower real estate appreciation through the rest of the decade unless interest rates trend even lower. Because remember the rule of 10x, interest rates trend lower, then prices go up. But right now we're really just bound by that affordability curve we saw at the Redfin data center. So either way we slice it, and I want to be very clear, these percentages are estimations. There's no way for me or for us to be able to predict exactly what's going to happen here. But it makes sense that even if we take out all of these percentages, we could very well possibly see a V-shaped dip at the beginning of 2021. And this means, folks, you want to get educated in buying real estate if you're an investor, because this could be the time, a short time, that you could take advantage of buying low and allowing that to appreciate. So what could make the V worse or what could make it even better? Well, there are two big asterisks here. Number one, if Congress finally gets their act together and provides rental relief, that V might not happen. I'd argue that it won't. We could literally, instead of seeing the V happen, we could literally just see the market kind of continuing across really this bridge here. We could see it just continue across here and we really not have much of a dip as we look at a 20, 30, or $40 billion of rental relief. And I think it's very likely that we see this. I do believe Congress will act. And if Congress acts, this V may not happen. This V only works if Congress does not act to bail out tenants. The only other thing that could possibly create a crash, in my opinion, in real estate, and something that would be more long lasting and potentially even more damaging, would be if interest rates go up. Reality is we are going to see inflation, which is related to interest rates. That will likely have a negative, a very negative effect on the market. If inflation goes up, the Federal Reserve likes to increase interest rates to combat inflation and bring it back down. They want inflation to be around 2%. If it goes up too high, they'll raise rates to bring it down. But right now, we've got many indicators that we aren't going to really see any meaningful rise in inflation. We're going to see a spike in inflation possibly in March and April, but many are claiming that that will be temporary. In fact, with the lack of stimulus, the reality is worries of inflation seem to have faded even more and more right now, and we're seeing more indicators of disinflation than inflation going up. So the Federal Reserve has also promised to maintain a quote accommodative stance until we are well into an economic recovery. And what this means is that the Fed is unlikely to mess with interest rates and raise rates until what many experts are predicting 24 or 2025. So we have a ways to go, and it's crazy how far we have to go. I mean, 4 to 5 years, basically the earliest any Federal Reserve banker thinks rates are going to go up is what I've heard is 2023. If anything, rates are probably, it seems, just going to continue trending low. So here's the bottom line. For 2021, we've got a situation where if Congress bails out tenants with stimulus and rental relief, we probably won't see a significant decrease at all at the beginning of 2021. If Congress does not bail out tenants, we could see prices net down 5 to 10% over the year with a sharper decline at the beginning of the year. Even if you disagree with my numbers, I do think that we can all agree that we will see some shape of a V, a temporary dip in the prices because of an eviction crisis. However, as low rates continue to prop up demand, we'll likely have a floor, and therefore we'll see these prices return. I wouldn't be surprised if we ended 2021 pretty much flat in real estate. We'd really have to go far to see a foreclosure crisis. Prices would have to fall 20 to 30%, which depending on how many people get evicted, it depends, but you look at the October rent data and November rent data, it's improving. People seem to be catching up. People don't want to get evicted, and if people are catching up and people don't want to get evicted, then this actually minimizes the size of the V. And since rates are staying stable and low, at least at the moment, then the housing decline might actually be very avoidable. If we have an eviction crisis, we will see a V though. So if you're thinking about getting into the real estate market, or if you're looking for an opportunity to shop, perhaps early 2021 might be an opportunity. As of now, Treasury Secretary Mnuchin has mentioned many times that he's a proponent of renter relief. So right now, they're just really under this casual extended deadline through the end of the year. So those are my thoughts on the possible real estate decline and how you can look at these key pieces of the puzzle, put them together, look at the numbers, and then really decide for yourself. That would be my encouragement to you. Test everything, hold fast to what's good, really examine the data that I've given you, and really decide for yourself what you can anticipate happening. That's all, folks. Hope this video helps. Looking forward to seeing you next time. Until then, take care.